Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Rocket Lab.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, so let's start with the top line story. I mean, this company is just in a clear hyper-growth phase.
Oh, absolutely. The numbers, they really paint a clear picture. Q3 2025 revenue came in at a record $155 million.
And that figure itself is good, but it's the pace that's really staggering. A 48% jump year over year.
Right. And that substantially beat what the street was expecting. It shows the foundational business is, scaling aggressively.
That 48% isn't just a number. It shows they're executing faster than people thought. But, in the space industry, it's all about capital. So how is that revenue actually translating to the bottom line?
And that's where the margins come in. This might be the most impressive part. GAAP gross margins hit a record 37% in Q3.
Wow, 37%. For a company that's still so heavily invested in hardware and manufacturing, that's huge.
It is. It signals really strong operating leverage. Basically, they're squeezing more profit out of every new dollar of revenue as they grow.
Okay, so if margins are expanding, the losses should be narrowing faster than expected, and that's what happened.
Exactly. The Q3 EPS loss was much smaller, beating the consensus by a wide margin. The market was braced for a deeper loss, so it suggests they're hitting that profitability inflection point faster than anyone believed.
And what about looking forward? How's the visibility?
It's exceptional. They are sitting on a massive $1.1 billion backlog. For you, the listener, that's a critical number. It represents future contracted revenue.
But with any backlog, you have to ask about the quality of it. Is this firm demand?
It is. Over 57% of that $1 billion is expected to convert into revenue within just the next 12 months.
Okay, so very near term.
Very. And a lot of it, especially on the defense side, is structured to protect those margins. So it's validated demand, not just, a speculative pipeline.
And all of this has to be supported by a strong balance sheet, especially when you're funding a whole new rocket program.
For sure. And their liquidity is robust. They've got over $1 billion in cash and equivalents on hand.
So that gives them plenty of runway to fund Neutron without needing to tap the markets anytime soon.
Right. It minimizes that shareholder dilution risk. But here's a really interesting detail that was kind of buried in the financials.
The operating cash flow.
Yes. For the first 9 months of 2025, it was actually positive.
Which is a huge milestone.
It's critical. It means the core day-to-day business-building satellites, launching Electron, that's already generating cash. The negative free cash flow is all from deliberately investing in the future, in Neutron. The core business is already supporting itself.
That distinction is it's fundamental to the whole bull case.
It really is.
Okay, so let's pivot from the financials to their competitive moat. Because the story here has really shifted from just a launch company to something more, right?
It's an essential integrated space infrastructure provider now. That's the key differentiator. Vertical integration.
The end-to-end model.
Exactly. They've launched with Electron, but they also have the huge space systems, segment satellite manufacturing, components, mission services. For a government or defense client, that one-stop shop model is incredibly appealing. It just reduces complexity and risk.
And that trust you need for a one-stop shop is built on reliability. How's their launch record looking?
It's arguably best in class for their segment. The Electron rocket had 19 launches in 2025.
19, a new annual record for them.
And they maintained a 100% success rate for the entire year.
Yeah. In the aerospace world, a 100% record over that many missions that's the ultimate calling card.
It's what unlocks those recurring high-value contracts. It's why big international players like JXAK and the European Space Agency, the ESA, they keep coming back for missions.
Which brings us to those big contract wins. We have to talk about the defense relationship here.
Yes, the defense angle is where their value really shines. They got that SDA prime contract, which alone is over $816 million.
And the SDA, the Space Development Agency, is the Pentagon's fast-moving arm for building out those next-gen satellite constellations. Winning that prime contract is a massive vote of confidence.
It immediately put Rocket Lab into the top tier of U.S. national security suppliers. That one win pushed their total defense backlog to over $1.3 billion.
And this isn't commercial work. This is depth security, stringent compliance. Once you're embedded in that infrastructure, the revenue is incredibly sticky.
And it all ties back to that space system segment we mentioned. It's now the majority of their revenue. The company's primary income is from manufacturing and components, not just launch.
I also saw a note about the margins on those components.
That's the hidden gem. The components division, reaction wheels, star trackers, that part of the business generates gross margins in the 60 to 70% range.
60 to 70. Wow.
Yeah. These are high-tech proprietary parts that are flight-proven on their own rockets. We even saw a nearly $1 million Canadian dollar R&D grant from the Canadian Space Agency to develop new, larger reaction wheels.
So it's government-validated state-of-the-art tech.
Exactly.
Okay, so we have this really sound, reliable core business. But let's be honest, the market isn't pricing the stock based on the Electron rocket. The real swing factor, the whole reason for the hype, is Neutron.
Neutron is everything. It's the reason investors are willing to tolerate the current cash burn.
Yeah.
It's this reusable, medium-lift rocket designed to bridge a huge gap in the market.
Right, it's bigger than Electron's niche, but smaller and more nimble than the heavy lifters. It's targeting that massive LEO constellation market.
A market that demands cadence and reusability. And the whole program really hinges on them hitting that inaugural launch target of Q1 2026.
So what's the latest? Have there been any recent milestones that de-risk that timeline?
There has, and it's a crucial one. It's about the rocket's reusability system. Specifically, the successful qualification of the unique first-stage fairing. They call it the Hungry Hippo.
The Hungry Hippo, I love that. But what's the engineering significance there?
Well, what's fascinating is the design. Most reusable rockets, they just drop their fairings and either lose them or try to catch them separately.
Right.
Neutron's design is totally different. The fairing actually stays attached to the first stage booster all the way through re-entry and landing.
So you're asking this giant clamshell mechanism to survive re-entry while still attached to the booster. That sounds like an incredible engineering challenge.
It's a huge technical hurdle. By qualifying that integrated structure now, they've significantly de-risked one of the most complex parts of the vehicle's reuse system, way ahead of the first launch.
Okay, so a major technical risk is now off the table. Let's connect this back to the financials. You mentioned Neutron is the reason for the cash burn. Can they sustain it?
Well, management has been very clear that they are at or near the peak of R&D spending for Neutron.
Okay.
The guided adjusted EBITDA loss for Q4 is expected to be near that high range of negative $23 to $29 million. And that loss is tied directly to this final development phase.
So the implication for an investor is that once Neutron is flying and generating revenue, that R&D spending drops off fast.
Exactly. It sets the stage for a major free cash flow inflection point. The heaviest financial lifting is almost over.
And all of this is happening with a huge sector-wide tailwind. The valuation of private space companies is just immense. Rocket Lab is kind of the credible, publicly traded, pure-play alternative.
They really are.
But, of course, we have to look at the risks. And the biggest one here is pure execution. If the entire thesis hinges on Neutron, what happens if that Q1 2026 launch date slips?
That is the material risk. The high valuation means the market has priced in near-perfect execution. Any delay wouldn't just be a calendar setback. It would trigger a material re-rating of the stock.
Because it pushes that free cash flow inflection point further out.
Right, and cost overruns could eat into that healthy billion-dollar cash reserve.
And about that high valuation, the price-to-sales multiple is pretty eye-watering.
It is. That's the premium you pay for access to the growth of the space economy.
Yeah.
But it also means there's just no room for error. Any hiccup gets magnified in the share price.
And that volatility is compounded by the recent insider activity, right? There's been significant selling by the CEO and a director.
Absolutely. Now, these are often pre-planned, but the sheer volume creates psychological headwinds. It contributes to the stock being what we call high beta.
Meaning it moves faster than the market, both up and down.
Exactly. We saw a classic sell the news reaction recently, a successful launch, and the stock drops over 10%.
Yeah.
You have to be prepared for that kind of volatility.
Okay, so we have execution risk and high volatility. Does the technical picture offer any reassurance for the long-term investor?
It does. Despite the swings, the stock is in a confirmed uptrend. It's trading above both its 50-day and 200-day moving averages.
That's the golden cross pattern traders watch.
Right? It signals robust long-term momentum. And if you look at who owns the stock, institutional conviction is high.
How high?
Institutional ownership is around 72%. So, pensions, mutual funds, the big firms, they've done their homework. They're accumulating the stock. viewing the risks as manageable against the long-term upside.
And that conviction seems to be echoed by analysts. We're seeing bullish recommendations reiterated, price targets being raised significantly. Some high targets are even reaching, what, $83?
Yes, which signals strong faith in the multi-year trajectory, not just the next quarter.
So bringing it all together, what's the final takeaway?
I think it's that Rocket Lab has successfully made the jump from a promising startup to an incredibly well-executed, vertically integrated asset for both commercial and national security. They've shown the financial leverage and the operational reliability to justify that high-growth valuation.
But the whole story, for now, hinges on one thing. That transition from peak investment in Neutron to actually seeing it fly and make money.
Right. They've cleared major technical hurdles, like that hungry hippo fairing. But the next 12 months are the ultimate test. This isn't a short-term trade. It demands a multi-year horizon to really see the payoff.
So here's a final thought for you to chew on. If Neutron succeeds and they nail that high cadence reusability, does the sheer profitability of their 60 to 70% margin component business eventually become the main story, eclipsing the launch segment entirely? Does Rocket Lab's identity actually shift from a rocket company to a high-margin industrial tech firm that just happens to own its own delivery service?
Something to ponder. If you found our analysis useful, please consider subscribing, liking, and commenting to support our work.
We'll be back tomorrow with another talk on the information that matters most to you.